Well, hi, this is Pete Bennett, the founder of Buzz Conferencing, and today I have on the line my very good friend Steve Bradshaw, who's a chartered accountant and tax advisor, who has sent me something which he calls his tax-busting checklist, and this is great. There are 19 points on this checklist as to how we can optimize our tax position and save ourselves some money. And I'm not going to ask Steve to go through all of the 19 points, but we're hoping that we're going to hit 5 of them now and give you a way of contacting Steve later on if you'd like some more information. So without further ado, may I introduce Steve? Are you there?
Hi Pete, yes, I'm here. Just to say that it's the personal edition of the tax busting checklist, so there is one also for businesses and an overall one as well. So this is aimed at individuals and the tax savings and investments, tax efficient investments that they can make.
Brilliant. And what we should say before we go any further is that this is a chat between two friends. I've known Steve for over 20 years now, and he does all of my financial planning and tax advice. It's not investment advice, so before you make any decision, you should seek formal advice. This is for information and training purposes only.
Yeah, well, I'll just go a bit further than that. Actually, It's actually also not tax advice. You should seek bespoke tax advice on any of these things before you actually do anything. You should make sure it's appropriate for you and seek appropriate advice from either your accountant or ourselves or your financial advisor.
Brilliant. Very well put. Okay, well, let's dive in. We don't have too long together, so the first thing I want to pull out on here is that most people, myself included, tend to have investments but very rarely go back and revisit them, and perhaps there is a good reason we should be less complacent than most of us are. Can you just explain a little bit what the benefits would be of reviewing your investment portfolio?
Well, a good financial advisor, and there are a few of those around, to be absolutely honest. I've been batting them off for years, but we've got a great one now called Carl Drummond, would carry out an annual review of your investments and also review your risk profile to make sure that your investment portfolio matched your risk profile and that you were getting the right rewards for that, but also to make sure that you were making full use of any tax-efficient investments that there may be around that the government do give people to encourage them to save. So it's just making sure that where appropriate, those are fully utilised.
Okay, so tax-busting tip number 1 is don't be complacent. Go back and review because life changes and perhaps your objectives change as well. Okay,
yeah, absolutely.
That's
get a decent financial advisor and make sure that they do carry out an annual review.
Okay, perfect. Well, I've written that down. I should be doing that, and I suggest everybody else does too. You mentioned tax-efficient investments there. Now, the only one that I really know about is an ISA, and I think over the years the government has sort of put up the amount that you can stick into an ISA every year. But there are some other ones as well, I believe. So perhaps you can just remind people how much they can put into an ISA each year, and perhaps some of the other ones that are less well publicised that people could take advantage of.
Right. Okay. Yeah. The annual investment in an ISA, so tax-free investment in an ISA is £11,280. If you could also have a cash ISA, which is just half of that, which is 5,640. So that's the basic limits for ISAs. So they restrict the amount that you can get tax-free through those. There are also national savings certificates or premium bonds, as us older generation would know them. Yeah. And basically that's what you're getting there. You buy a national savings certificate, and that puts you into a draw for prizes, and the prizes are tax-free. And obviously you're not guaranteed a win, but over a long period of time, then the return should equal a reasonable tax-free return. So that's quite good, and it's quite nice to get a nice surprise through landing on the doormat sometimes in a brown envelope rather than a letter from the taxman. The other one is friendly society investments. which are also they are tax-free investments, but limited. You can put £270 a year or £25 a month into those. But again, it's utilising those. But you need to work out whether they get the right sort of return for you. I don't think they get fantastic returns. But again, speak with a decent IFA and they'll be able to guide you.
I love premium bonds. To be honest, I didn't really consider them as a tax-free investment. I'm glad that you've mentioned this. I just sort of thought it was a little bit of a flutter, but
no,
it is great.
Government sponsored. That's right, government-sponsored gambling. It's fantastic. but it is. You can always withdraw your capital. So basically, it's the government using your capital and then giving some people prizes every now and again.
So there's no real risk with those, is there? You can pull it at any time and just get the cash back out.
That's right. Yeah, your capital's always safe. Well, as safe as any other government type of security, I guess, which is questionable these days. Never would have been, but is these days.
It is, yeah. Okay, I like the next tip actually. So tip number 2 is just to summarise. Tip number 2 is make sure you're making the best of all the tax-free allowances with your savings plans. So tip number 3 then. Those of us who are married will sometimes curse how expensive it can be, but there are actually some tax advantages of sharing some of your allowances with your spouse, I believe. I don't pretend to understand this, but perhaps you can elaborate a little bit, please.
Well, if you've got if you're paying tax at different rates, so if the spouse is either a lower or a higher rate taxpayer, then you can equalise the income, if you like, so you utilise as much of the lower taxpayers' bands as possible by perhaps giving them beneficial interest in some of your investments. So, but again, you're giving a spouse some income or some rights over your investments, and you should probably consider legal advice on the sort of aspects of that. Also, if you've got your own business, then you may be able to justify taking them on as a partner, and if they're a non-taxpayer, for example, then taking them on as a partner if you've got a sole tradership, or if you've got your own limited company, then you could give them as long as you can justify it, a sort of basic wage for doing some role for you in the business, or indeed shares. You do need to be careful about giving spouses shares, because there are rules that stop any tax avoidance. So although there are often ways around the tax avoidance rules, then you do need to take advice before doing so.
So quite complicated perhaps, but well worth looking at if you're in the position that you think you may benefit from that sort of arrangement, I think, in summary.
Yep, it's worth talking with your accountant or financial advisor to see what there might be available there.
Okay, brilliant. Okay, so that's tip number 3. Share the love, and maybe involving your spouse in there with some appropriate advice may be useful. Okay, just 2 more tips to go out of the 19 on this list. It's amazing how time flies, isn't it? Tip number 4. I had no idea that your children can actually earn wages. I mean, I know in the old days we used to shove them up chimneys and stuff, but there are no chimneys anymore now. They just do web design. But I didn't realise that they could actually earn money. What's all that about?
Well, it's not necessarily earning wages. What some of that's referring to is that they could receive investment income. Now, that's not. There are rules that stop it being them getting investment income from investments which were their parents, or investments settled by their parents. If it's grandparents, then that's fine. So if you've got wealthy grandparents, then they may be able to put an amount into an investment, and the child can earn up to their basic rate tax band. Up to their they can utilise their personal allowance by getting some tax-free investment income. You could also, if you do have your own business, as long as they are of an age that they can be employed, again, you could, if you can justify it, employ them in the business and pay them a wage, as long as you take into account the employment law in that regard, and make sure that you're not employing children too young and sending them up chimneys and that sort of thing.
It's considered impolite nowadays, isn't it? But
yes.
Thank you.
Yeah. Well, the chimneys are generally blocked up, I guess.
They are. But it's amazing, isn't it? Once you start drilling into this stuff, there is so much that you can do to optimise your position that the average person in the street would have no idea about. I mean, this has been a real eye-opener to me, and I consider myself reasonably well tuned into this stuff, having been in business for a few years. So this is great. Okay, we've got one more area to consider, and I forget who it is now that said there's only one thing certain, and that's death and taxes. Well, we've talked a little bit about taxes. Let's talk about when the music stops, getting a will. Why should we get a will, apart from the obvious, and perhaps what's the downside if we don't, from a financial and tax perspective? Because we want to make sure we look after people when we're gone, don't we?
Yes, for sure. On a sort of non-financial and tax perspective, there's the whole issue of guardianship and that sort of thing for your children. So if you have minor children that can't look after yourself, then you don't really want to put them in the hands of the state. If you do, both husband and wife die at the same time. So it's good to have a will just to get guardianship sorted out. But from a financial perspective, you also want your wishes to be carried out as to who would get what you leave, and rather than put that into the intestate rules. If you don't have a will, it's up to the intestate rules of who gets what. But further than that, you can obviously do some tax planning to make sure that the assets are left in a tax efficient manner, so that the more is left to your estate and to the people you want it left to, rather than going to the government for them to spend on what they want to spend on Euro budgets and that sort of thing. So it is very important to have a will to start with, and then also to make sure it's updated regularly to take into account any increases in value of properties and that sort of thing. So it's just a good idea to make sure that all that's covered, especially if you have your own business, because the asset value there and making sure you get business property relief and on all that sort of thing is quite important.
I'll say this list of 19 or so tips has been a real revelation to me. There is so much in here that had never occurred to me, and I now need to go through it and tick all of the boxes. I'm sure other people that are listening may benefit from this list as well. I mean, is there a way, Steve, that people can contact you and find out more about what's on this list, and possibly you can point them in the right direction on some of this, or where to get further advice? Yeah,
for sure. If they email me, which is probably the best way to do it, because then I could just attach it back as an attachment, a PDF attachment. They email me at s.bradshaw, BRADSHAW, at montgomeryswann.com. That's MONTGOMERYSWANN.com. Then I can forward it to them.
Well, that's brilliant. Steve, thanks ever so much for giving up some of your valuable time to talk to me today. I'm going to take this away and go through it one at a time and tick the boxes, and I'm sure that other people that are listening to this will have found it equally valuable. So, Steve, thanks so much for your time. I shan't delay you any further, and we'll meet up again soon, no doubt.
My pleasure, Pete. Thanks very much.
Cheers.
Bye then.